Are you thinking of getting involved in commercial property investment? It seems with rising interest rates, investors are looking for strong cash flow and more investors are thinking about commercial property. Now, while it might look like the exclusive preserve of the rich and famous, well, it looks that way from afar, as you edge a little bit closer, you're going to see that commercial property investments are well within the domain of many current residential property investors as well. But unfortunately, I've seen many investors go wrong with commercial real estate because they don't really realise the rules for commercial property are very different to residential investing. And they're given a false sense of security from some of the podcasts and some of the blogs encouraging this type of investment. Now, I bought my first commercial property in the 70s, so I've made all the mistakes. But today I'd like to give you some clarity and direction regarding this because commercial property is right for some investors. But building a substantial asset base through commercial property is not easy, and it does impose greater risks than residential real estate. But to help you understand why so many professional investors own commercial real estate, and to see if it's something that you should consider if you wanted to get to the next level of your investment, I've dedicated this entire episode of the Michael Yardney podcast to shops, warehouses and offices as I discuss commercial real estate with Brett Warren, National Director of Metropole Property Strategists. So welcome to today's show.
Welcome to the Michael Yardney podcast, where twice each week you will learn a number of new ideas regarding success, property investment and money in around 30 minutes. Our show is brought to you by Metropole, who specialise in helping you grow, protect and pass on your wealth through strategic property and wealth advice. Now here's your host, Michael Yardney, Australia's authority in wealth creation through property, who has been voted one of Australia's top 50 most influential thought leaders.
Have you thought about investing in commercial property? Now, you're not alone. Faced with the prospect of more moderate returns from their residential property investments, I know many investors are considering this as an alternative. And by that I mean offices, shops or warehouses. Now, some investors are looking for diversification in their investment portfolio. Others are looking for more positive cash flow. Now, some investors have noticed that the financial institutions, the institutional investors, as well as many of the investors in the Rich 200 lists own mainly commercial properties. So in today's podcast, I'm chatting with Brett Warren, National Director of Metropole Property Strategists, about the benefits of investing in commercial property. Welcome, Brett.
Yeah, good to be with you, Michael. And look, I'm certainly seeing a few more clients interested in finding out about commercial property, and it's probably had a good run in recent years. There's been reasonably strong returns and a stable income, and I guess, Michael, a perceived low risk as part as well. And look, people want to get different exposure and diversification to different sectors of the economy. There's different tax benefits. It's a great way of hedging against inflation and, controlling your investment. There's also, surprisingly, I know a lot of people don't think about it, but you can probably still add value there at some stage, and it's a great tool to leverage as well. But like every form of investing, even with residential property, there's a real complex market factors, and it's quite different with commercial property, isn't it? There's the financing setups, the deposit, the interest rates. Then you've got to look at the property management, of the property, the leasing arrangements. And I guess you've got to get a really good grasp of the potential risk. So, Michael, I'm keen to talk to you about it because I know you've been investing in commercial property for quite a long time.
Yeah, look, I bought my first commercial property in the 1970s. I bought two factories in Dandenong Street, Dandenong, an industrial area. But Brett, looking back, it was a bit too early in my investment career to do that.
Oh, what makes you say that?
Well, while commercial property's got strong cash flow, it's got much weaker capital growth than residential property. So I saw what the big guys were doing, and I wanted to do what they did, thinking I was smart. Boy, I was still young and arrogant in those days, and there wasn't all this education available. So it was too early in my investment career. I really needed more capital growth to build my asset base, but I started investing in commercial property, and I sold up those ones after a few years to invest in something else.
Yeah, look, it's a great point. I know we advocate for widening your asset base first, and I guess we're talking about commercial property, but there's also a right time, and I guess we'll get to that. But do you still invest in commercial property today?
Sure. Well, now that I've got a very substantial portfolio, it's a blend of residential and commercial property. So I've got shops, factories, offices. In the past, I've been involved in commercial property development. We've built a number of office buildings. I've actually built the commercial properties that I now own, the factories that I now own. I was even involved in an industrial land subdivision, taking a farm and making a whole lot of industrial lots and selling it off to developers. So I've seen it all over the last 5 decades, Brett.
Yeah, that's really interesting. And I guess, like everything, there's pros and cons. So maybe we start with the benefits of investing in commercial property, Michael.
Well, I think they can be summarised in a couple of ways. First of all, there are higher yields than residential. So, look, it's gone down a bit. Yields are now lower than they used to be, and they're probably going to go up again a little bit over the time, but somewhere between 4 and 7%. But they tend to be net yields. In other words, the tenant pays the outgoings, so they're stronger returns on your money than for residential property. The leases tend to be for longer periods, so for 3 to 5 years rather than the normal 12-month lease, and the tenants pay the outgoings. So who wouldn't like to have a tenant who'd commit themselves for 3, 5, even 10 years and pay all your costs for you? You've got to understand that tenants also in commercial property are more likely to look after it a bit better than your residential property, because the shopkeeper is going to look after his shop front. A factory owner is going to make sure that it's a nice environment to work in. So they conduct their businesses from the premises. So there's a few advantages there. When things go well, they're less management intensive than residential property. The tenants tend not to complain as much, but boy, over COVID, was they more management intensive when shops, offices, and to a lesser degree, people in factories just couldn't pay their rents. I think one of the other big factors people don't realise is to get into good commercial property, you actually need more money. It's a more expensive exercise than buying an apartment or a house. And when the bank lends you against that property, they won't lend you as high a loan-to-value ratio and usually at a higher interest rate. And the other big factor is when they become vacant. Commercial properties remain vacant for longer. How often, Brett, have you driven past a small shopping centre and you've seen that for lease sign there month after month?
Yeah, you said it, Michael, especially recently with COVID and the lockdowns and things like that as well. It's quite unfortunate.
Yes. So you've got to have deeper pockets and be able to wear these periods of longer vacancies. And then when a tenant moves in, and we know that because while we're commercial investors, we're also tenants in our office in Brisbane where you're sitting at the moment. The landlord had to give us huge incentives to actually take on extra space. So the leases are different. The cycle of investment is different. The leases are more complex. You need legal advice. And I think in general, Brett, it's easier for the average investor to pick a top-performing residential investment. Not that that's easy on its own, but it's easier because they have a better understanding than what happens in a commercial property, Brett.
Yeah, look, I can see commercial property, it's just completely different. I think that's where people get trapped and there's a lot of misunderstandings between the differences. And I guess there's a lot of people, investors in particular, that, buy those commercial properties with the residential real estate rules in mind. And, they end up significantly overpaying or doing things that put themselves at risk.
Definitely. I've seen a lot of that recently where people have got $1 million in their super fund, $2 million, and they're going off and buying a retail property at very low yields. And the experienced investors are just shaking their head wondering, what's going on here? Now, there are lots of benefits of getting involved in commercial property, the strong returns, the good income, tax benefits, they're a good hedge against inflation, and you've got the leverage, but you've got to know what you're doing, Brett.
Well, yeah, that's right. And look, at Metropole, we always talk a little bit about our six-stranded approach to buying properties where we can add value. But I think most people wouldn't realise you can do the same with commercial property, but the rules are probably slightly different. So maybe you could explain some ways we could add value to a commercial property, Michael.
Sure. So it's not as easy, but you can renovate. Now, let me explain that if you buy commercial property that's leased, you in general have to pay more for it because of the security of the lease. And let's imagine that it's leased to Coles for the next 10, 20 years. You're going to accept a lower return because there's less risk. So on the other hand, if the property is vacant, you actually pay less for it. Now, that's very different to residential. In residential property, you actually don't always want to have a tenant there, and so it's actually worth more vacant because you've got options and because owner-occupiers can buy. But for commercial property, if you understand what you're doing and it's vacant, you can actually renovate it or upgrade it or improve it so that you can then lease it for a higher yield, and that way add value. Now, with industrial properties, you can buy a large block with a factory on a portion of it and subdivide some of the block or put another factory there. You can improve the appearance of your property. With a lot of shops in the strip shopping centres, we've seen people obtain permission for redevelopment, and you've got the shop downstairs and 2, maybe 3 levels of dwellings upstairs. So that's the way that a lot of the strip shopping centres around Australia's capital cities are changing. Or because the value of your property has a lot to do with the lease, just renegotiating the lease for a longer lease, different terms, can add value to your property. Or sometimes changing the use of the property, like I said a moment ago, starting it with what was just an office or a shop downstairs. Now you can have residential as well. So there's a number of ways that you can use the strategies that we use for residential property, also for commercial property, Brett.
Yeah, look, you're painting a pretty picture there, Michael. What could possibly go wrong? High returns, growth, everything's going great. I know obviously there's some cons, so maybe we talk a little bit about the negatives to give a bit of a balanced approach. And we also talked a little bit about timing as well in terms of the wealth creation side of things. So what are your thoughts there? Okay,
well, maybe we answer one of those at a time. So commercial property is appropriate when you've already started to build up an asset base and you're looking for more cash flow. I know at the moment, as part of the strategic property plans we're writing for clients, we're including commercial property as an option when finance allows them to do that, and it's easier to move to the next level because of the higher cash flow of commercial. But again, you've got to do it in the right order. Asset base growth first, and then commercial property, because that's the mistake I made because no one told me about that before. In fact, commercial property doesn't grow anywhere near as strongly in capital growth because the growth is in general pinned to the increase in rents, which in general are linked to the CPI.
That's an interesting thing, Michael, because I have seen a lot of commercial properties actually do quite well recently, and people start to think that they can continually get that kind of level of growth, don't they? But it clearly doesn't happen. So we talked a little bit about timing, and now I guess just a little bit about the negatives or the disadvantages of commercial property.
Sure, I did paint a rosy picture. So one of the things is the lack of liquidity. Selling a commercial property can take several months, often longer, even if it's a well-located property, compared to residential property, which if you had to get out, you'd put it up for auction and in 4 weeks' time, you'd have a buyer. The other thing is it's actually very difficult to understand what the right values are, what you should offer, unless you're in the commercial market all the time, because there's not the same amount of pricing information compared to residential property where you can look on a whole lot of websites and you can get data from CoreLogic or PropTrack. There's lack of pricing information, comparable sales values, and there's also scarcity of other information. There's lots of blogs, podcasts, newspapers, websites educating residential investors, but very little educating commercial investors. And the other big downside is entry level for commercial properties is usually higher. Now, I've actually seen advertisers, we've been looking for some commercial properties for clients, properties in Alice Springs and in Darwin where you can buy a factory with huge yields, very strong and very cheap. But you don't want a mum and dad business in a small area where if they go broke, it's going to be vacant for 2 years. There's a reason those properties are cheap, and there's a reason they're being offered on a high yield. So if you want to own a good commercial property, you need more money, bigger deposit, because the banks usually won't lend you as high a loan to value ratio. Having said that, there's a lot of strata commercial properties, shops and warehouses. I'm not really comfortable with strata offices. That's another discussion. The office sector is suffering at the moment with the work from home trend anyway. So there are ways of still getting good locations, but it's not as cheap as residential property, Brett.
Great points, and thanks for the overview. I see that the issue is a lot of people are attracted to these high yields, aren't they? They want
Yeah, yeah.
6, 7, 11%. They don't really understand that that's actually linked to much higher risk. So we talked a little bit about perceived risks at the start, and I dare say the higher the return, the greater the risk, and that's what
Always.
people certainly need to
Otherwise,
understand.
people would pay more for it, wouldn't they?
Yeah,
Yeah.
that's right. So, in your opinion, Michael, who should consider investing in commercial property and who shouldn't?
Well, as we regularly say in this podcast, Brett, property investment's a process, not an event. So it all starts with understanding what your end game is. What are you hoping for the properties to do for you? And for most people, as we said at the beginning, it's to replace their personal exertion income and give them choices in life. And that's why I know some people are saying, well, commercial property is going to give me more income, more cash flow. The problem is commercial rents in general are linked to the CPI. Most leases are linked to either 3%, which is actually below the CPI, or CPI. And similarly, commercial values go up around the same. They increase in line with inflation. And we know that real estate, well-located real estate, has increased in value, residential real estate, much higher than that. So it's got to, first of all, you've got to understand, what are you wanting your property to do? And then, as I said a bit earlier on, you've got to work through the phases of your own wealth creation journey. So in my mind, the first phase is educating yourself about all the options, then getting good advice, followed by the asset growth stage of your journey, where you're building an asset base, followed by the next stage where you're lowering your loan to value ratio so that you can then get to the cash flow stage. So that's the time, in my mind, when commercial property is appropriate because of the increased cash flow. But it's wrong investment to start off a property portfolio with.
Yeah, and you mentioned timing there, Michael. Is now a good time to get into commercial property?
Well, yes, for some it is, and for lots of people it isn't. So commercial values and yields vary depending upon the prevailing interest rate. Very different to residential property. Residential property values really are driven by owner-occupiers. 70% of people who own residential property are owner-occupiers, and so they drive market values. Also, supply and demand and interest rates also make a factor, of course. Commercial properties, a few landlords own their own dwellings, businesses as premises, but the majority of them are owned by investors. Now, I'm not just talking about in the city where it's the big institutions, but also in the strip shopping centres and the factories and the offices. So professional investors have a different requirement, and so that's what drives commercial property values. And when interest rates were very low over the last couple of years, we dissuaded our clients from getting involved in commercial property. We said, wrong time in the cycle, because now that interest rates are higher, professional investors are expecting a higher return from all their investments, whether it's bonds, whether it's money in the bank, whether it's commercial property. And so therefore, an investment that would have maybe returned $100,000 a year now is not worth anything as much as it was when people were accepting a 2% return, because now if you're only going to accept a 4, 5, 6% yield because the cost of your money's gone up and because other investment opportunities are higher, it brings down the value of commercial properties. Commercial property values and yields are very much driven by the economy and interest rates. But now that we haven't reached the top of the interest rate cycle yet, Brett, but there's probably only another 1 or 2, maybe 0.25% interest rate rises, then I see it's not a bad time at all to get into commercial property, knowing that values have dropped a bit because people are expecting higher returns. But as you said at the beginning, many don't understand that, so they're actually buying on 2 and 3% yields and then wondering why the value of their property's gone down.
Yeah, look, it's a whole different kettle of fish, isn't it? Compared to residential. So I appreciate you sharing those thoughts. And look, what are your top tips, I guess, for building wealth through commercial property?
Well, successful commercial investment requires an understanding of a whole lot of complex market factors. So does residential investment. You've got to understand finance, tax, the law, the economy, supply and demand, but even more so for commercial because the financing is different, property management options are different, the leases are very much more complicated. You've got to understand the the risks involved, because the risks for retail are very different to the risks for offices, are very different to the risks for industrial properties. So you've got to get a good team around you who understands that. And while I personally have been involved in commercial properties for, well, I guess over 40 years now, and so I know, and I've seen the cycles, and I've been involved in building them, developing them, owning them. Our team at Metropole has done a lot of research and understands as well. So we help guide our clients. So part of it is to understand the complexities of it and get a good team around you. And you've also got to understand what COVID-19 coronavirus has done, how it's affected our economy, how certain sectors of the commercial property market are going to be different in the short term and maybe even in the long term, Brett.
Yeah, it's a good lesson. And obviously, we understand that could potentially happen again one day. So if you can avoid those mistakes, then you're kind of one step ahead, aren't you?
Sure. So once you ask for some tips, you've got to do your due diligence. You've got to do your market research. You've got to understand the different commercial markets, get to know what's going on, learn about the economy. What are the vacancy rates for shops in your area? Boy, there's some really good shopping strips, but when you walk past them, drive through them, you're actually going to see lots of vacant shops there. So what's the upside potential as well? So you've got to do your due diligence. Then I think it's just like residential, Brett. You've got to invest in prime locations, whether it's commercial, retail, industrial, high demand locations that are going to be popular with commercial tenants and also potential owner-occupiers or investors, because the quality of your assets in commercial, in my mind, is even more important, if that's possible, than with residential property. The rules are different what makes a prime location in commercial. And you also then have to understand, what is it that somebody requires in a factory? Do you understand the requirements of getting pallets in and out, of turning circles for semi-trailers, how they need to be near transport? Because today the transport really is along freeways. In the old days, it used to be close to the ports, or it used to be close to the railway lines. So prime position for shops is very different. Prime position for industrial and offices, well, they have certain requirements as well. I think for a beginning investor, even though I talked about the upside of buying a vacant property and then getting a better yield once it's leased, I think you should be buying a leased property when you're starting off. It just minimises your risks. Sure, you're going to pay for the premium, the security of having a tenant, but you've also got to understand what makes a good lease, what makes a good tenant, and not overpay. Brett, I remember a number of years ago, I think it was in the 90s, the banks sold off a lot of their retail premises. They realised they didn't need to have as many. They're doing the same again recently.
All going online. Yeah.
They're doing it now. But in the 90s, they did it as well. And what they did was they took 5-year leasebacks on very high rental returns. So what they did was they sold to assuming mum and dad investors who thought, hey, I've got the ANZ Bank. I'm not pulling out just one. Or NAB, they all did it. I've got this bank tenant. They're going to be there for life. At the end of the 5 years, the bank said, no, don't need 3 branches in the same suburb anymore.
Yeah,
and
that.
Now they're saying the same, hey, I don't need as many branches. I'm going online. And when the lease expires, the unassuming, unexpecting investor suddenly realizes, I've actually paid too much for the property because I was sold by the owner-occupier on a much higher rent than market rent. So all of a sudden, the value of their properties decreased considerably. So understand leases. I think the other thing is understand that you can get great depreciation allowance from properties, the office buildings in particular, but also industrial and shops. If it's a newer tenancy, a newer construction, you often get great depreciation allowance. But as the markets are changing, as requirements are changing, find something that's a flexible floor print, not an inefficient layout where it may be difficult to sublease certain areas. Industrial buildings, make sure you've got the right proportion of office space, or that you can increase office space, because interestingly, a lot of factories now are not manufacturing anymore, they're warehousing, so they need more people in the office for sales. And again, when you're more mature into the market, then you can look at development potential, look for undercapitalised properties, one where tenants are paying below market rent, or properties that are underdeveloped and you can add value to it. So that's the next stage. But again, it comes back to don't believe everything you say. Definitely don't believe the commercial agents who are trying to sell you their properties. So get a good team of people around you. And I am going to shamelessly plug our team at Metropole, because we're not only thinking about commercial property. So there's a lot of buyers agents who will only sell commercial property. There are many buyers agents who have no idea about it and correctly stay out of the commercial field. But if you've got a team like ours, Brett, who can offer it to you as an option, but not as the only option. So you're not going to be told commercial only, or industrial only, or residential only. If we're doing the right thing for you by starting with a plan, they're the sort of people that you should have on your side. So, Brett, if somebody's keen to find out a little bit more about whether it's appropriate for them, would you be happy if they give you a call to have a chat?
Yeah, definitely. And I think you've summarised it really, really well there, Michael. There's obviously a lot of positives with commercial property, but there's also a lot of risks and a lot of negatives. But I think you've outlined how you can probably control those risks a bit better than just going out and buying a property, and some of the insights around timing and what type of property, commercial property to buy first up was really, really important. So be more than happy to talk to as many people as we can.
Sure. So I'll leave a link in the show notes. Just go to metropole.com.au and why not find out what your options are? Let's have a complimentary clarity consultation. And if it's residential property, I know, Brett, you and I are seeing a great opportunity, a window of opportunity, because with interest rates now not going up as much, I think a lot of people are suddenly realising that, hey, the end of all this is in sight.
Absolutely. And I think it won't be too far before inflation probably starts to head the same way. So you're 100% right. We're buying better than we probably were 6 or 12 months ago, and probably better than we will be in another 6 or 12 months, Michael.
I think that's a good point. So we're not suggesting the residential market has bottomed yet, but it's looking for a bottom. And we're not trying to time that. But at the moment, when there's less people looking, when it's a buyer's market, so you've got the upper hand in negotiation, when you've got time to do your due diligence, it's a great time to look at residential. But if you're already an established investor and you're looking to diversify, or you're looking to play like the big boys are, why not have a chat with Brett Warren about getting involved in commercial property? Go to metropole.com.au. I'll leave a link in the show notes. Thanks, Brett, and thank you for twisting the microphone around and asking me the questions this time.
Always a pleasure to put the spotlight back on you, Michael. No problem.
Thanks, mate. Bye.
Thanks again. Bye.
Now here's Michael's mindset message. Remember, a change in your thinking will lead to a change in your life.
In my mindset message today, I'd like to talk with you about a strange way to attract more wealth. Now, at the risk of sounding woo-woo, I'm going to share with you let's call it non-practical way to attract more money, success and wealth. Sure, I teach many hardcore techniques in my blogs, in my podcast, in my writings, but another side of increasing your success and your wealth that's equally important has to do with what's going on between your ears. And I'm talking about how valuable you believe you are. Now, stick with me because this could be a game changer for you. The late, great Jim Rohn taught work harder on yourself than you do on your job. Now, you've probably heard me quote Jim Rohn on this point before, but I'm not talking about working on yourself with regard to investments or money or finance knowledge. But my point today is by working harder on yourself, you bring greater value to the marketplace. And when you bring greater value to the marketplace, your income increases. Now, this isn't just if you're in business, serving your clients or your prospects or your patients, but it's also if you're an employee because you bring more value to your boss, to your employer. But it goes beyond that. When you sincerely work hard on yourself, you naturally develop a deeper level of confidence. And when your confidence increases, you make bolder choices. And when you make bolder choices, you experience breakthroughs. But it goes beyond that. When you're sincerely confident, that energy is felt by people around you, by clients, by prospects, by your employer, by other staff members, by people that you manage. And they in turn feel confident in you and your ability to produce results. And that naturally leads to more of whatever you're wanting in success in your life. There's a lot of people out there teaching techniques such as affirmations to increase your confidence. Now, to be honest, that's never worked for me. What has worked is investing in myself, whether that means paying for coaches, paying for mentors, going to seminars when we could, blocking off time to read, listening to podcasts, spending time exercising, improving my health. You don't increase your confidence levels by faking it, but you do by taking disciplined action, which shows that you value yourself. So here's my challenge for you today. Schedule at least 1 hour this week to do something that increases how you value yourself. And it doesn't, and it actually shouldn't be related to work. It should be something where you're working on yourself. Maybe it could be reading a good book. Maybe it's taking a walk with no electronics. Maybe it's meditating, yoga, exercise. But until you place a higher value on yourself, your clients, your employer, your partner, people around you won't place a higher value on you either. I hope you enjoyed my chat with Brett Warren, and it's given you another way of looking at property investment. And if you found some benefit in this and you know somebody else who'd benefit from this type of information, why not tell them about the Michael Yardney podcast, whether they're interested in commercial real estate or just in property investment or success in general. There's a share button on all podcast apps, or just tell them in the old-fashioned way, or why not tell the world by leaving a review? And I every now and then read out some of the many reviews I get, and if I'm about to read out your review, or when I read out yours when you leave me one, I'd be happy to say thank you by gifting you one of my books. So I'm going to read out a couple of reviews, and if this is yours, email me michael@metropole.com.au with your details, and I'll gift you one of my books for saying thank you. Now, Jace Coates left a 5-star review on Apple Podcasts, and he said, Michael and his guests provide unrivaled experience and knowledge of the property market that covers all aspects of the economy, demographics, and has changed my whole approach to investing. In December 2019, I listened to media and so-called experts and sold my 2 properties. And he went on to say that if he would have listened to me, he would have actually got a different result. So thank you for those real kind words, Jace. And Josh and Beth actually left a 5-star review also saying intelligent advice. As a new listener, at the beginning of my property investment journey, I love Michael's podcast. It's authentic and purposeful with intelligent advice and strategies. I look forward to learning more from Michael and his guests. Thank you. Well, thank you for those kind words, Josh. And I'm glad that you're educating yourself, because that's the first stage of the property investment journey. I'll be back again real soon, but you can catch me in between these shows on social media. Just look for Michael Yardney, or why not join my private Facebook group where every day I leave some tips, some tricks, some information for you where you're going to learn more about property investment, success and money. Go to Facebook and look for the Property Update private Facebook group. In the meantime, I'll be back real soon. Have a great week. Make it a great week.
Thanks for listening to this episode of the Michael Yardney podcast, which was brought to you by Metropole, who help their clients grow, protect, and pass on their wealth through strategic property and wealth advice. If you like what you heard and don't already subscribe, you'll find us on iTunes or on your favorite Android app as the Michael Yardney podcast. Watch out for our next show, which comes to you twice a week, and you'll learn some new ideas about property investment, success, and money in around 30 minutes. To get more of Michael's thoughts, go across to www.propertyupdate.com.au and sign up for his daily morning briefing, and you'll hear from not only Michael but a group of leading property success and money experts. And just a reminder that the information you heard in this show today is general educational advice and not specific investment advice, as we don't know your personal circumstances. If you're looking for specific advice, why not ask the team at Metropole to help you?